Well, welcome to our discussion of revenue. Up to this point in time in the class, we've been talking about expenditures. Now we're going to turn our attention and look at the revenue side of the budget. So we'll divide the discussion up into two sections. The first half, which will be the lengthier half, will look at taxation from revenue-based tax sources, and then the second half will look at non-tax sources. But before we get into the different types of tax revenue sources that we have to rely upon as local governments, I think it's important to look at the tax evaluative criteria. There are 5 tax evaluative criteria that we look at in determining which type of taxation to utilize and which type of tax we want to raise as opposed to another type of tax. Because of our 3 main forms of taxation, property, income, and sales taxes, you will see that there are some advantages and some disadvantages. Some are more progressive, some are more regressive than others. So I think it's important that we have some criteria that we can use in selecting between these different revenue sources. So our first evaluative criteria we use in taxation is what we call burden distribution. And this is quite simply the question of who pays the tax. We can distribute the burden of taxation either on an ability to pay or a benefits received principle. If we do it on an ability to pay principle, then we are obviously going to charge higher tax rates to those who have more of an ability to pay the tax. Benefits received principle, only those who get a benefit from consuming a good, those are the folks who pay the tax. If you do not consume the good, you don't purchase it, then you will not pay the tax because ostensibly you are not receiving any benefit from that good. So who pays the tax burden? Is it on ability to pay or a benefits received principle? We'll see as we talk about our 3 main forms of taxation. Some of them, such as income taxes, are an example of ability to pay, whereas a benefits received principle is something that we'll see with sales and consumption-based taxes. Our second criteria is the criteria of equity, and this is fairness. We can divide equity up into 2 different types of equity. There is horizontal equity and there's vertical equity. Horizontal equity asks the question, are 2 similarly situated individuals paying the same amount in taxation? So do we have that type of horizontal equity within an ability bracket? Vertical equity asks the question, do people who have more of an ability to pay a higher share in taxation than those who have less of an ability to pay? So with vertical equity, we are looking across ability levels. So hopefully we'll be able to put together a tax structure that is both equitable on a horizontal nature as well as on a vertical type of nature. Then our third criteria is adequacy. Quite simply, we need a tax that will generate an adequate amount of revenue to cover our expenditures. Number 4 is collectability. Some taxes are easier to collect than others. And there are a couple of different dimensions here with collectability. The first thing that we need to consider with collectability is the taxpayer passive or taxpayer active nature of the tax. So some taxes are very taxpayer active, where we rely upon the taxpayer to take an active role in calculating and remitting the amount of taxation that they owe. In a taxpayer passive type of tax, it's done for the taxpayer. So the taxpayer doesn't take an active part in calculating and then remitting the taxation that they owe to the government. The rule of thumb is the more taxpayer passive a tax is, the easier it is to collect. The more taxpayer active it is, the more difficult it is to collect. So when you think about some of our major forms of taxation, you'll see they differ in terms of being taxpayer passive or being taxpayer active. One very taxpayer passive type of tax tends to be the sales tax. The sales tax gets rolled into the price that you are paying for a good, and so it's something that's collected by the vendor. It's collected by the vendor. You have a smaller number of vendors than you do taxpayers, so it makes much more efficient collectability. Other forms of taxation are much more taxpayer active. If you think about the income tax, with the income tax you have elements of both. But on April 15th, that income tax becomes very much taxpayer active. in that the taxpayer must fill out their tax forms, they must declare their income, they must calculate their tax liability, and then remit that tax liability to the governing authority. Very taxpayer active on April 15th. But throughout the remainder of the year, through the withholding process, it tends to be relatively taxpayer passive, because your employer will withhold at whatever rate you tell your employer to withhold at. They will withhold your income tax liability. And there's not a whole lot you do about that. You can always change your number of withholdings, but for the most part, it's a very taxpayer passive aspect of the income tax. Property taxes, it depends. And property taxes can be either taxpayer passive or taxpayer active. If you have your taxes, if you're a homeowner and you have your taxes rolled into escrow, then you make your taxes you make your tax payment as part of your normal monthly mortgage payment. That makes it very taxpayer passive. It's just rolled into your mortgage payment. However, if you don't have your taxes escrowed into your mortgage, then twice a year you'll get this very big property tax bill and you'll have to pay that. So it's very taxpayer active without escrowing. So again, it kind of depends. Collectability is a difficult thing for some governments to measure because there are two aspects of collectability. There's tax effort and there's tax capacity. Tax capacity speaks to the assessed valuation of property within a jurisdiction, the capability of the jurisdiction to generate that type of tax revenue. Tax effort is the amount of effort that jurisdiction puts in to collecting the taxes that are owed to it. So you want to have a high tax capacity, and you also want to have a high level of tax effort in order to get good collectability with whatever form of taxation that you are using. And then the fifth and final evaluative criteria is economic effect. We know that taxation is not insulated from economic fluctuations, and this is really a two-way street. Increasing taxes could have an impact upon your economy. So taxes can impact the economy, but the amount of tax revenue you're able to generate is also very closely tied to fluctuations in your economy. So if you have a lot of people out of work, you're going to be able to collect less income tax revenue than in better economic times. So here we just have to remember it is a two-way street. Some taxes are better insulated from the economy than others. So an example of an insulated type of tax would be something like the property tax. For the most part, people buy houses. And, it's that whole dream of home ownership. And so people really are not necessarily going to not buy a home because of the tax rate, unless it's a ridiculously high tax rate. If you have Melrose like we have here in California, you may end up with a tax bill that's 3 times as high as someone who lives a couple of streets away. But absent that, for the most part, people are still going to buy houses even though they're going to be subject to property taxes. For the most part, property tax revenue also tends to be relatively stable, irrespective of what's going on in the economy. Now, we had a great housing crisis about a decade ago, and that housing crisis obviously slowed down the home buying environment, and so you have fewer people buying houses. Fewer people buying houses, you have fewer people paying property taxes. But for the most part, if you track and you put together a chart looking at property tax collections over time, you'll see that there's a pretty pronounced incline in your trend line for property tax collection. So it tends to be pretty well insulated from a lot of economic fluctuations. So those are 5 basic criteria we tend to look at when we are choosing between different sources of tax revenue. So let's jump in briefly to each of the 3 main sources of tax revenue, talk about how they work, and then illustrate some of their advantages and some of their disadvantages. Now, what surprises a lot of people in the state of California is that property tax is no longer the primary source of revenue for California local governments. For years, we came to anticipate that the highest percentage of revenue for local government would be from the property tax. In the wake of Proposition 13 in 1978, we saw states gradually decreasing their reliance upon the property tax and looking to other non-traditional forms of revenue, kind of supplement for those lost property tax revenues. Now, if you look at the typical city in the state of California, you'll see that their largest source of revenue is probably going to come from non-tax sources such as user fees and user charges. fines and forfeitures and things such as that. But the property tax still remains a pretty significant source of revenue for a lot of city governments. The property tax has a tendency to be very regressive in nature. And by regressive, we mean that it tends to impact people from lower income levels more seriously than people from upper income levels. Now, we know that the basis on which you pay your property tax is your assessed valuation of your home. So it is a wealth-based tax, and we are charging people based upon their wealth being defined as the assessed value of their home. There certainly can be a disconnect between the value of your home and your income. And you can have a very expensive home that you've inherited, but you don't have enough income then to pay that very high property tax bill. So it does have a tendency to be relatively regressive from that equity type of standpoint. Also, the way in which we do the property tax here in California tends to violate horizontal equity, but we'll get into that in a couple of minutes. The amount of revenue that you can generate from the property tax is going to be contingent upon a couple of different things. One, it will be contingent upon the tax rate that's being charged, and number two, it will be contingent upon the assessed valuation of the property. Now, most states, including California, will limit the property tax rate that local governments can charge to their homeowners. Here in California, that property tax rate limit comes to us in the form of Proposition 13, and it's a 1% property tax rate limit. Most states express their property tax rate limitations in percentages. So if it's a 1% property tax rate limit, it means that you can only charge up to $1 per $100 of assessed valuation in taxation. So it's 1 per 100, it's a percentage. Some other states will use what they call millage rates. A millage rate is $1 of taxation per $1,000 of assessed value. But the majority of states, including California, will express their tax rates in terms of percentages. Then you can also limit assessment. So again, the assessed valuation of the property is what you then apply the property tax rate to then calculate the final property tax liability for that homeowner. A lot of states, including California, will place a limitation on the rate at which the assessed valuation of property can increase from one year to the next. So states are very keenly interested in limiting the access of local governments to property tax revenue. In California, we have a rate limit and we have an assessment limit. When you combine a rate limit with an assessment limit, you then create a new type of property tax limitation known as a levy limit. So a rate limit in combination with an assessment limit results in what we call a property tax levy limit. A property tax levy limit will limit the overall amount of property tax revenue that a local government can generate. Now, if you only have a rate limitation and you don't have an assessment limit, then that doesn't limit the amount of property tax revenue that can be generated, because you're limited in terms of your rate, but you can always then increase the assessed valuation of property. Likewise, if you only have an assessment limit and not a rate limit, then all you have to do is increase the property tax rate, and then you'll end up generating more property tax revenue. It's when you combine the two together, the rate limit and the assessment limit, that's what gives you this property tax levy limit. That is then what is restrictive in terms of the amount of property tax revenue that local governments generate. Here in California, Proposition 13 is the example of a property tax levy limit. But how you assess the value of property is very important, a very important consideration for calculating tax liability. Some states will reassess the value of property on an annual basis, where every single year they'll go back and they'll say, well, this house is worth more, and so we're going to increase its assessed value. Some states do it on a less frequent basis, but states do tend to use different bases for doing these assessments. And it's very important, the value that you assess your property at will have a direct impact, obviously, on the amount of property tax revenue that you can generate. A lot of states tend to use what they call a market value approach to assessing the value of property. they'll use a current market value approach. And the current market value approach would ask the question, if this house was for sale now, how much would this house sell for? That then becomes the assessed valuation of that house. Here in California, we use what's called the welcome stranger approach. The welcome stranger approach only reassesses the value of property when that property changes hands. So only when it changes hands will it then be reassessed for taxation purposes. And that's, again, courtesy of Proposition 13. It's this welcome stranger approach that presents problems for horizontal equity. Because you may have two identical homes situated right next to each other. Same amenities, built in the same year, in the same condition, the same square footage. The one was purchased in 1975. The other one was purchased in 2015. The one that was purchased in 2015 will have a much higher tax bill than the one in 1975. Because the one in 1975 is subject, or has been subject every year, to an assessment rate limitation of 2%. So it's only been able to increase in assessed value by 2% per year. Well, the other house that was purchased in 2015 was purchased at 2015 prices. So if you had the one purchased in 1975 was purchased for $50,000, the one in 2015 was purchased for $500,000, you can assume that you're going to have a tenfold increase in the property tax liability for that house that was purchased in 2015. So there's a lot of that violation of horizontal equity with the welcome stranger approach. But the idea behind a welcome stranger approach is that we are going to keep people from being taxed out of their homes if they are living in a neighborhood or living in a local jurisdiction or a state where it was very popular to move there. And so we didn't want people to say, well, I got to sell my home because I can't afford to pay my property taxes because my home has increased in value. Some other approaches for assessing assessed valuation, an income approach. So if you have an apartment building that generates income, you can then use that income calculation for the calculation of your assessed valuation. A costing approach, we ask the question, if we had to replace this structure, how much would it cost us in prevailing construction costs to replace the structure? So what's the cost of replacement? A lot of states will use what they call fractional assessment, where they will assess different types of property differently. So an example would be agriculture property. So if you have agricultural land that's used in farming, that may be only assessed at 10% of its current market value, whereas a single family home might be assessed at 100% of current market value. Here in California, for single family homes, we do 100% of the last sales price when that home changed hands. That's what we use as our basis for assessed valuation. Some other states may say we're going to use current market value, but we'll only charge you, we'll only calculate your assessed valuation at 30% of what the current market value is of your home. So some states give taxpayers a lot more of a break in terms of their assessed valuation through fractional assessment. Our goal, though, with the property tax is hopefully to try and maintain some element of equity, which is difficult with the welcome stranger approach, to try and maintain some element of equity between similarly situated homeowners. And one of the measures we use for that, one of the statistics, is what's called the coefficient of dispersion. And the coefficient of dispersion will show us how great the differences are in the property tax liability between two similarly situated homeowners. For a single family residence, we would hope that we'd have a coefficient of dispersion of less than 15%. So it's less than 15% variation in the property tax liability of similarly situated properties. If they're newer properties you're comparing, then obviously you want to have a much smaller percentage than 15%. With a welcome stranger approach, you're not going to get a 15%. You're going to be well above 15%. You may be upwards of well over 80, 90% differences in their property tax bills. That's just one of the downsides of a welcome stranger approach. Well, one of the major property tax reductions, if you will, that we have seen nationwide is what California did in 1978 with Proposition 13, which we've already mentioned, and we'll talk about on the next slide. But basically what Proposition 13 does is it limits the tax rate to 1% and then limits the assessed valuation increase from one year to the next to a maximum of a 2% increase. So you're combining, again, the rate limit, the assessment limit, to then limit the total amount of property tax revenue that local government can generate. So those are very common types of limitations we see used around the country. We also see states use what are called exemptions. And a very popular type of exemption is called a homestead exemption. In a homestead exemption, the state will exempt a certain amount of the value of the home from property tax liability. So the typical amount is $7,500. That's how it is here in California. You can subtract $7,500 directly off the value of your home in calculating your tax bill. You do not have to pay taxes on the first $7,500 of the value of your home. Then we also have things called abatements. Abatements are negotiated tax breaks, typically usually done between a government and a business. So to attract a business in your locality, you might negotiate some tax breaks. So if you move into our jurisdiction, you will not have to pay property taxes for the first 5 years that you are here. That's a negotiated tax break. That's usually referred to as an abatement. So a lot of different ways in which we can try and reduce tax burden. Again, Proposition 13 really kind of became a model for the country back in 1978 when it was approved by California voters. The purpose of Proposition 13 was to try and shield homeowners from being taxed out of their homes. So your home only gets reassessed when you sell it. So it's the buyer who comes in and gets the higher tax bill. We carved out some exemptions for inheritances. And so we have Proposition 58 and Proposition 193 that exempted inheritances by children, and then the other one exempted inheritances by grandchildren, so that you could have property passed down through generations that would still be exempt from being reevaluated and reassessed. Now that may be changing this year. We'll talk about it in a second, but that's probably going to be changing this year depending on what the voters decide to do. But Proposition 13, again, it's a 1% tax rate limit, and it's a 2% increase on how much the assessed value can increase from one year to the next. Now, you may look at a property tax bill, if you have a property tax bill, and say, my tax rate's above 1%. Well, it may very well be, because we have local add-ons that can take your tax rate above 1%. So you might be in a sewer district and have a sewer assessment that's added onto it, storm sewer assessment. You may have some, additional, maybe you have, new lights on your street, and so that gets added in as an assessment district. So if you look at your tax bill, you'll see all these add-ons, these local add-ons that may take you up to maybe 1.2 or 1.25%. That's very, very common to see. If you live in a new development, your tax bill may be greater than 1%, your tax rate, because you may live in the area of what we call Mello-Roos. Mello-Roos is an ability to try and generate revenue to compensate the government for the increased use of facilities. And so if you're starting a new development, you're going to build hundreds of houses, you're going to be attracting thousands of people. Well, those thousands of people will put a strain on the existing infrastructure. So you may create a Mello-Roos district there, and you may then charge the developer additional tax burden in order to construct a new school to accommodate all the kids that are coming into that new area. Maybe construct a new library, maybe construct a new fire station. And so it's to pay for increased infrastructure requirements for having this increased population. In California, a lot of those Mello-Roos taxes come in the form of what we call community facilities districts, or CFDs. And so governments will join together and create a community facilities district. Then that community facilities district will impose Mello-Roos taxes on the developer. oftentimes what developers will do is they will prepay those Mello-Roos taxes, and then as people start to move into the community, then the developer will then recoup those taxes from those people who are moving into the community. Some Mello-Roos, some community facilities districts will last for 20 years, some last for 30 years, some may not have any sunset provisions. But there's always what's called a mitigation agreement that is signed by the government and the developer that will spell out all the requirements of this community facilities district and the amount of Mello-Roos taxes that are being paid and the payment schedule for those Mello-Roos taxes. So if you live in a community facilities district, you will have a much higher property tax bill than someone who does not. Now, on the November 2020 ballot, there is an issue that it's called the Split Roll Initiative. And the Split Roll Initiative is intended to try and carve out the advantages, the property tax advantages that have been given to businesses. Because under Proposition 13, both residential as well as commercial and industrial property benefited from these limitations. They benefited from the shielding of an increase in assessed valuation. The Split Roll Initiative is saying, well, except for small businesses, we are going to have larger businesses pay taxes based upon the higher valuation of their property, so they'll no longer be shielded from those higher property tax bills by Proposition 13. It will generate tens of billions of dollars, and that money is intended to go to local government, schools, counties, and cities. But that is on the ballot November 2020, which would be a fundamental change to the way in which Prop 13 operates. So keep an eye on that. Split Roll Initiative is Proposition 15 on the November 2020 ballot. So that's a basic, really quick overview of the property tax and how the property tax works. Let's then relate it back to those 5 evaluative criteria we started the discussion with. So the property tax and burden distribution. As we said, it is a wealth-based tax. It's based upon your ability to pay. Your ability to pay is defined by the value of your home. In terms of equity, it tends to be relatively regressive, both from a vertical as well as a horizontal perspective. It's regressive from a vertical perspective because, again, there's a disconnect between the value of your home and your income. So someone with a relatively low income may have a very high property tax bill. It also violates horizontal equity whenever you use the welcome stranger approach for the reasons we have described before. Adequacy, it tends to do very well on. It's a very adequate type of tax. You generate a good deal of revenue from the property tax. And it also tends to be very stable type of revenue. In terms of collectability, it tends to be a very collectible type of tax. It's a very collectible type of tax as measured by the 97% collection rate that we see most local governments be able to achieve. The expectation, actually, of credit rating bureaus is that local governments will collect at least 97% of the property tax levy that they are owed. And we tend to see cities kind of hover around 97, 98%. So it tends to be a relatively collectible type of tax. As we mentioned before, in terms of economic effect, it's of the 3 forms of taxation, it's probably the one that is best insulated from economic fluctuations. Then the second main type of taxation are income taxes. Income taxes are primarily used at the federal and the state level and at the local level in some states. In California, it's primarily not used at the local level, but some other states, local governments will be heavily reliant upon income taxes. Income taxes are usually designed as what we call graduated tax systems, in that we will establish marginal tax brackets, and as you move up those marginal tax brackets, the income tax rate will increase for each one of those tax brackets. And we'll look at that in a second. You define income as usually adjusted gross income, your AGI, and that's going to be the basis on which we will start calculating your income tax liability. Well, at the federal level, as a result of the 2017 Tax Cuts and Jobs Act, you had a fundamental change to your federal income tax brackets. And you can see on the screen basically, and there can be some modifications here, but basically you have 7 major federal income tax brackets: 10, 12, 22, 24, 32, 35, and 37%. The amount that you pay will be dependent upon the tax bracket you fall in and your filing status. Are you filing single, married filing jointly, married filing separately, head of household? So as you can see, for every, say you're a single taxpayer, for every dollar you make under $9,875, you will pay 10% in taxation to the federal government. For every dollar above $9,875 up to $40,125, you will pay 12%. For every dollar above $40,125 up to $85,525, you will pay 22%, and so on and so on. So if someone says, well, I'm in the 24% tax bracket, that doesn't mean they're paying 24% on their entire income. They would only be paying 24% on the amount above $85,525 if they are a single taxpayer. That's what we call a graduated marginal tax bracket system. California models their tax brackets on the federal level. There's a little bit of difference there. As you can see, there are more bracket categories: 1, 2, 4, 6, 8, 9.3, 10.3, 11.3, 12.3, and 13.3%. But again, the same general idea applies to the California marginal brackets as applied to the federal brackets. Now, you're not going to pay taxation on your entire income that you have generated, on your entire adjusted gross income. Because from that adjusted gross income, before you calculate your tax liability, you will have some what we call circuit breakers. Circuit breakers are laws that are designed to reduce the burden of taxation on taxpayers. So one example of a circuit breaker will be deductions. Deductions are there to try and adjust for filing status and to try and encourage certain types of spending patterns and behaviors. So you can either claim a standard deduction or you can itemize your deductions. Now, in the 2017 tax law, they greatly increased the amount of the standard deduction because they were trying to encourage more people to claim a standard deduction and fewer people to itemize their deductions. But if you have major deductions, such as if you own a home, you can deduct the amount that you pay in your payments on your home, your interest payments, and that is one of the major deductions that you can take. If you own a home, probably you're going to be itemizing your taxes, and you're going to want to pull those deductions out separately and itemize as opposed to just claiming the basic standard deduction. Itemized deductions are there again to encourage certain types of behaviors. So we want to encourage people to purchase homes. And so we allow them to deduct the interest that they paid on their mortgage for that year. We allow people to deduct donations to charity because we want to encourage people to give money to charity. If you have medical expenses over a certain amount based on your income threshold, you may be able to deduct those medical expenses as well. They can sometimes deduct moving expenses, job relocation expenses, job retraining expenses, because we really do want to not only encourage certain behavior, but also we want to make sure we're taxing people more on their net income than we are on their gross income. So deductions can be a powerful tool to then reduce your tax burden. So those deductions will come off of your adjusted gross income and reduce your tax liability. Then we had a second category of circuit breakers known as exemptions. Now, in the 2017 law, a lot of these exemptions went away, and so we don't have them anymore. But exemptions would allow you to exempt a certain dollar amount from your income, your adjusted gross income, based upon your family size. So for every additional person in your house, you would be able to exempt, $2,600 from your income from taxation. But again, much of those went away in the 2017 law. Deductions and exemptions occur before you calculate your tax liability. So deductions and exemptions will come off of your adjusted gross income. Tax credits are much more powerful tools because tax credits come off after you've already calculated your tax liability. So, say you calculate your tax liability and you say, I'm going to owe the federal government $5,000, but you have 3 qualifying child tax credits. And so we'll say those are $1,500 each. So that's $4,500 in child tax credits you have. You subtract that from the $5,000 you owe, and now your tax bill is only $500. So they have directly reduced your tax bill from $5,000 down to $500. That's what makes credits so powerful, is that credits come off after the fact. They come off after you calculate your tax liability. Deduction and exemptions are calculated in before you calculate your tax liability. So deduction and exemptions come off your adjusted gross income. Tax credits come off of your tax liability. So a true tax credit is a very powerful circuit breaker that can substantially reduce someone's income tax burden. But the thing to be careful about is there are a lot of deductions that masquerade as tax credits. So Congress will write a law creating a deduction, but they'll call it a tax credit. In order to truly be a tax credit, look at where it occurs on your tax form. Only if it occurs after you calculate your tax liability can it truly be considered to be a tax credit. So these circuit breakers are there to try and reduce the tax liability for taxpayers. So they're a positive thing for taxpayers. The problem with circuit breakers, though, is that there are so many of them that they become very confusing. The federal income tax code is literally thousands upon thousands of pages long. We always talk about the loopholes that exist for higher income individuals. And the example that usually is given is Warren Buffett, where he says that he actually pays a lower tax rate than his secretary pays. Now, he'll pay more in total dollars, but his tax rate will actually be lower. And it'll be lower because he qualifies for a lot more circuit breakers, a lot more of these tax loopholes than his secretary may qualify for. So it creates a lot of confusion, and it also throws the equity off balance when you have too many loopholes and too many circuit breakers for wealthy individuals and for wealthy companies. We've all seen the story about how Amazon didn't pay any taxes in the last tax year because they had so many things that they could write off and so many circuit breakers they could take advantage of. Also, for circuit breakers to truly work, you need to engage in what's called indexation. Indexation is making changes to those circuit breakers to account for changes in the economy. And so we know that we have inflationary factors, and so there'll be an inflation that will erode the value of the dollar every single year. If we don't keep up with those changes in inflation, then our circuit breakers are become less and less and less powerful over time. Another problem is what's called the alternative minimum tax. The alternative minimum tax was designed to make sure that everyone pays their fair share in taxation, so that very wealthy people would not get away without paying any tax liability. The problem with the alternative minimum tax is for many, many years it wasn't changed. And so as people's salaries went up, more and more middle income taxpayers were being ensnared in this alternative minimum tax. And what happens with the alternative minimum tax is if your income level goes above a certain threshold, you lose your deductions, and your deductions then go away. So we had some middle income taxpayers who really should be getting deductions who weren't getting them because they were subject to the alternative minimum tax. Well, in the 2017 Job and Tax Act that Congress passed, they actually redid the alternative minimum tax. They greatly increased the income threshold to try and mitigate that problem. But for many years, middle-income taxpayers are being forced to pay the alternative minimum tax, which greatly increased their tax liability. Then we also have payroll taxes, and these payroll taxes have been in the news recently because the Trump administration has talked about exempting people through the rest of the year from payroll taxes. These payroll taxes are collected by your employer, and your employer then matches these amounts. 6.2% is collected from your check to pay for Social Security, and then your employer matches that amount. 1.45% is collected for Medicare, and your employer matches that amount as well. Up through the first, it used to be $127,200 of income. Now that's been increased, and every year that keeps increasing. Now I think we're up over $130,000. But for that first $130,000 or so of income, they will hold out 6.2% for Social Security and 1.45% for Medicare. Now, again, the Trump administration has talked about doing away with, or deferring, can't really do away with it, but defer those Social Security payroll taxes to try and increase the amount of money that people have in take-home pay. The problem, though, is if you're deferring them, then they all have to be repaid. And so only Congress can do that. And so if the Trump administration does convince employers to stop collecting the 6.2% for Social Security from their employees' paychecks, the employees will have to end up repaying that after the first of the year. And if you don't put that money back in, then Social Security becomes insolvent much quicker than it normally would. And we're looking at Social Security insolvency probably by about 2023 if those payroll taxes don't then get repaid after the first of the year. So we'll see how that all plays out, but there is a good chance that you may actually end up with some pretty big tax bills for some taxpayers. So the income tax, in terms of its evaluative criteria for taxation, again, burden distribution, it's an ability to pay type of tax. And we determine your ability to pay based upon your income levels. With equity, it gives the impression of being more progressive in nature because of these marginal tax brackets, because of the circuit breakers that we talked about. But also, as we mentioned, a lot of those circuit breakers are more accessible for people from higher income levels. And so sometimes the progressivity that we see with the income tax is sometimes a mirage, and it's more rhetoric than it is reality. Adequacy income tax is a very adequate type of tax. We collect a lot of revenue from it. That's why the federal government is almost solely reliant upon income taxes. Collectability is a very collectible type of tax through withholdings. And when money gets withheld from your check, then it's a very collectible type of tax. But as we said on April 15th, when you file your taxes, it becomes very taxpayer active. Economic effects. As we have seen, through the coronavirus pandemic, oftentimes you have more people out of work. More people are out of work means that they are not generating income. You have nothing to tax, and so there's less income tax revenue going into government coffers. So that's our second form of taxation, the income tax. Our third basic category of taxation are consumption-based taxes, and this is where sales taxes fall. In sales taxes, we tend to have either general or specific sales taxes. A general sales tax will apply to most goods that are being transacted within that jurisdiction. Specific sales taxes will apply to specific types of goods. With specific types of sales taxes, those are usually referred to as selective excise taxes. So selective excise tax is a specific tax applied to a specific type of good. So the tax you pay on a yacht may be different than the tax you pay on an automobile. Different types of selective excise taxes, as listed on the screen, are things such as luxury taxes. So that yacht tax is considered to be a luxury tax. Luxury taxes ostensibly will charge the tax burden to upper income individuals who have the money to purchase a yacht. The problem, though, is there's a trickle-down effect. And so if you increase the yacht tax too much, fewer people will be buying yachts. Fewer people buy yachts, fewer yachts need to be created. So the shipyards will then be laying people off. And so you'll actually end up financially hurting people who you're not intended to try and target. So sometimes luxury taxes don't work as well as we hope they would. Then another type of selective excise tax is a sumptuary tax. These are sometimes called sin taxes. So taxes on alcohol, taxes on tobacco products, those are sumptuary or sin taxes. The problem with sumptuary taxes is that sometimes they are presented to the public in a hypocritical way. So you'll have elected officials say, we are going to propose this sumptuary tax, this tax on tobacco products. And in doing so, we are going to get rid of this socially undesirable activity and generate a great deal of additional revenue. Well, those two things are mutually exclusive. If the tax is high enough that you are discouraging people from buying tobacco products, then you're not going to be generating a whole lot of additional revenue. If you're generating a whole lot of additional revenue, it means people are still buying and using tobacco products, so you have not diminished that socially undesirable behavior. So you really can't have both of those characteristics at the same time, but oftentimes we see elected officials sell sin taxes based upon that argument. A couple of decades ago, a lot of our new sports stadiums were paid for through sumptuary taxes, alcohol and tobacco-based taxes. Another type of selective excise tax is what's called a benefit-based excise tax. And a great example of one of those would be a motor fuels excise tax, otherwise known as the gas tax. So when you go and fill up your car, you know you're paying a federal gas tax and you're paying a state gas tax. So you may be paying up to 50 cents per gallon extra for federal and state motor fuels excise taxes. Those gas taxes are considered to be benefit-based excise taxes because, at least in theory, we are taking the revenue and we're putting that revenue into a highway trust fund. And we're going to then use that revenue to pay for road construction and road repair and reconstruction. Idea being, by putting the gas in your car and driving on the roads, you are getting a benefit from buying that gas. And so therefore, we're going to collect that money and put it into repairing the damage that's being caused by people having the benefit of driving on the roads. So again, just different types of consumption-based sales taxes. The problem with the sales tax, especially a general sales tax, is that it tends to be highly regressive. And it's highly regressive because people from upper income levels tend to have more disposable income. And economists usually define disposable income as the amount of income that people have left after they have purchased the staples of life. So after they have secured housing and they've secured clothing, they've secured food, they've paid for all that, then the money they have beyond that is what we call disposable income. Upper income individuals tend to have a lot more disposable income than lower income individuals. So if you do not exempt things like food and clothing and pharmaceuticals from that general sales tax, it will end up being very regressive in nature. Every state will have their own set of commodity-based exemptions. Some states are very generous. New Jersey, for example, for years would exempt the first $500 of clothes that you purchase from sales taxation. But it can get kind of wacky when you look at what states do with their commodity-based exemptions, and there's not a whole lot of rhyme and reason to some of these exemptions because they have been added on over the years. And so it's kind of a hodgepodge, piecemeal type of listing of exemptions from state to state. But absent those commodity-based exemptions, your sales tax probably will end up being very regressive. An alternative to a sales tax like we use here in the US is something called a VAT, VAT, value-added tax. We see value-added taxes used in the European Union and some of our other nations across the country, across the world. And the idea behind a value-added tax is that you will have a tax incident at every point in the production process where the value of the good increases. So whenever the manufacturer purchases the raw materials, that goes up in value. Those raw materials then go up in value. When the manufacturer then completes the manufacturing of the good and sells it to a wholesaler, it goes up in value again. When the wholesaler then sells it to the retailer, it goes up in value again. And then when the consumer walks in the door and purchases it, it goes up in value again. So at every point where there is value added, where the value of the commodity goes up, you then place taxation. So you are taxing the manufacturer, the wholesaler, the retailer, and then finally the consumer. Idea being, by spreading out the points of tax incidence, the consumer will then be better shielded from paying a large amount of taxation on that final commodity that they're purchasing. As you may guess, that usually doesn't work very well. We have a process of burden shifting that is very true in taxation, where people tend to support taxes that they can shift the burden onto someone else. So if I can shift the burden to someone else and I don't have to pay the tax, I'm going to like that tax a lot. That's one of the reasons why when we talked about sumptuary and sin taxes, why they're very popular. Because if there's a tax on tobacco products and you don't use tobacco products, you're probably going to be very much in favor of that tax because you're not paying that tax, somebody else is. But same type of thing here with the VAT. So whenever the manufacturer got that tax hit, they would just increase the price of the good that they're then selling to the wholesaler. Wholesaler does the same thing to the retailer, and then the retailer jacks up the price for the consumer. So value-added taxes really don't oftentimes achieve the goal that they're intended, which is to reduce the tax incidence for the consumer at the end of the process. Very hotly contested issue in consumption-based taxes over the past few decades has been taxing internet sales. As we know, the internet has exploded and people do a lot of their purchasing. Some people do all their purchasing on the internet. And so we need to know, how can state governments tax these sales on the internet? Many years ago, back in 1992, we had a very famous Supreme Court case called Quill versus North Dakota. The Quill versus North Dakota case was actually a mail order case because it was kind of before the internet really exploded. It was a mail order case that asked the question, can states tax transactions by companies that are not located within the state? And in the Quill case, what you had is Quill was a stationery company. And it was a stationery company that was located in North Dakota. North Dakota wanted to tax the transactions between North Dakota residents and the Quill Corporation through mail order. Well, obviously, Quill said, you can't do that because we're not located in your state. How can you, North Dakota, tax us when we're a Minnesota company? Case went up to the Supreme Court, and the Supreme Court agreed. Supreme Court said that Quill Corporation, because it wasn't located in the state of North Dakota, it was considered to be a remote seller. And as a remote seller, transactions conducted by that remote seller were not subject to the tax laws of the state of North Dakota. Now, if Minnesota wanted to tax them, Minnesota could because they were located within Minnesota. But if you're a remote seller, you are then not subject to tax laws from any state that you didn't have a physical presence in. So the court called a physical presence nexus. Corporations had to have a physical presence nexus with the state for the state to apply its sales taxes. So after Quill versus North Dakota was decided, states all got together in what was called a streamlined sales tax project. And for many years, they worked to put together a system that would allow them to tax corporations that did not have a physical presence within their state. We won't go through all the details of it, but the Streamlined Sales Tax Project was comprised of a majority of states in the country. They are working very hard to put together uniform legislation to allow them to tax remote sellers. But at the end of the day, the Supreme Court said in Quill versus North Dakota, whether or not states can tax remote sellers, that's a question that's left up to Congress. Well, recently, we had a new Supreme Court case that trumped the Quill versus North Dakota case, and that was the South Dakota versus Wayfair case, just otherwise known as the Wayfair case. And yes, that's the Wayfair company you see on commercials all the time. In the Wayfair case, the Supreme Court kind of reversed what they decided in Quill versus North Dakota, and they opened the door up for states to start taxing transactions conducted by remote sellers. And so as a result of the Wayfair case, you see the door open up for more state tax revenue by allowing states more opportunity to tax transactions between their citizens and corporations that are not located within their state. So it's another form of revenue that has now been opened up for a lot of state governments. So again, to wrap this up a little bit, we'll look at the sales tax in comparison to, again, those 5 evaluative criteria we started our discussion with. Burden distribution, the sales tax is a benefit received type of principle. You don't pay the tax unless you purchase the good, unless you are deriving a benefit from the purchase of that good. We said for equity, the sales tax usually is not very good unless you have the right set of commodity-based exemptions. It tends to be very regressive. Adequacy, the sales tax does tend to be a relatively adequate tax, and that's why we see state governments and local governments rely upon it relatively heavily. Every session of Congress, we have a member of Congress who introduces a bill to start a national sales tax. It hasn't really gotten anywhere because of a principle we call source separation. There's concern that the federal government also has a sales tax, and you have sales taxes at the federal and state and local level. You no longer have source separation. And those three levels would then impose such a high sales tax burden, it would have a price effect, which would then reduce the consumption of that good or that service. But it is a very adequate form of taxation for state and local governments. It's a very collectible tax, and of the three types of taxation, it is the most collectible because it is a taxpayer passive type of tax collected by vendors as opposed to remitted by taxpayers. However, with economic effects, it is probably the least insulated form of taxation. An economic downturn is going to mean we're going to get a lot less in sales tax revenue. That was the big concern in California with the May revise. And after the May revise is, well, what's going to happen to sales tax collection in California? Surprisingly, it didn't drop off as much as most people thought it would, but there are more rounds of sales tax remittance that are coming up, and so we may actually see the full effect of the coronavirus later as opposed to sooner. But downturn in the economy will have a negative impact upon sales tax collection. But also the sales tax can affect economic activity. So if you increase your sales tax rate too high, you get into this Laffer curve type of situation. That as you keep increasing your sales tax, you'll generate more sales tax revenue up to a critical point. And once that sales tax revenue, that rate becomes too high and it increases the price to this cost prohibitive level, then for elastic goods, people are going to start demanding less of those elastic goods. So the less demand, obviously, the less revenue that will be coming in. And so it is very closely tied to the economy. So it depends upon the state which form of taxation local governments have access to. In some states, local governments have access to property sales and income taxes. In some states, they only have access to property and sales taxes. In some states, there's not a sales tax. In 5 of the 50 states, there's no sales tax. So they have to rely upon property and or income taxes. So there's a great deal of variation between the states in their reliance on tax-based sources of revenue. But as we had said before, in the wake of Proposition 13 in 1978, local governments here in California were forced to shift their focus away from property taxes and shift more to a focus on non-tax sources of revenue like user charges and user fees. Now, as you read through your Mike Sell textbook, you will see that Mike Sell takes great pains to differentiate between what is a user charge and a user fee. And I think he is correct in doing so because there is a difference. A user charge is revenue that is derived from the provision of some type of a service. So someone is consuming a service and then paying a charge for the service that they are consuming. So your electric bill is like a user charge. And so you're using electricity and you pay based upon the amount of that service that you are using. With a user fee, there is no particular service that is being consumed. So user fees are usually attached to the privilege of engaging in some type of economic activity. So if you want to get a hunting license, you have to pay a fee. If you want to get a fishing license, you pay a fee. You want to get a driver's license, you pay a fee. You want to register your vehicle, you have to pay a fee. You want to start a franchise, you have to pay a franchise fee. So those fees are linked up to the privilege of engaging in some type of an activity. And that's the big difference between charges and fees. Charges are associated with the service. Fees are usually associated with the privilege of engaging in a certain type of activity. Now, that being said, as you look at your local government's finances, you'll probably see that the government kind of conflates the two. And sometimes they'll refer to charges and fees together in one category. So on a practical basis, when they report out their charges and fees, a lot of local governments don't make that distinction. But I do think it's an important distinction to recognize. User charges have become very popular, as well as user fees, for local governments. But the problem with a user charge is a user charge must be linked up to a service that has some private sector components to it. So you think back to our previous discussion of different types of goods: private goods, toll goods, common pool goods, and public goods. You really have to have some elements of a private good, such as benefit separation and chargeability. If you can't separate out the benefits that people are getting from consuming this service or this good, you're not able to charge them for the amount of benefit that they are getting. It's going to be very difficult for you to use a user charge. So the basic moral of that story is that we are limited in terms of our ability to utilize user charges. Some advantages of user charges, though, is they serve as a nice market surrogate. They allow us to gauge demand for a service. This is something we struggle to do in the public sector. When we pay for things out of general tax receipts, it's very difficult for us to know how much society is demanding of this particular good or service. If we charge a user charge, we are then able to gauge demand for that good or service. It improves equity because we can then target those who are benefiting. So rather than having a general broad-based tax where everybody pays it, only those people who are benefiting from consuming this type of service, those are the only ones who are paying the user charge. And then from an economic perspective, user charges also allow us to correct what we call cost price signals in the private market. And what does that mean? It means that a user charge can help us demonstrate to a private corporation the true cost of actions that they are engaging in. So you think about a charge that you would apply to that widget factory for polluting the river that runs behind the factory. That shows that company the true cost of polluting that river by having to pay a charge to clean up that pollution. But user charges, as we say, cannot apply in all situations. User charges tend to not work very well when we have goods that produce spillover effects, that have externalities. So if there are spillover effects, so we then create a bunch of free riders and people who are getting a benefit without paying for it, it's going to be hard for you to use a user charge because you can't identify who's gaining that benefit and then assign a charge to them. So goods and services that produce a lot of spillover effects usually don't work very well with user charges. Redistributive programs oftentimes don't work very well with user charges as well, because the very logic behind a redistributive program is we are going to redistribute wealth from one segment of society to another. So how can you then charge someone who you're trying to redistribute wealth to for consuming that redistributed wealth? They're getting that redistributed wealth because they don't have the wealth to begin with. And so redistributive programs usually don't work all that well with user charges. We typically need to have that connective tissue between the amount that someone is consuming and then the charge that they are paying for consuming that amount. If we don't have that chargeability, we don't have that excludability, it's going to be real tough for us to utilize user charges. So things like household supports, trash collection, tends to work really well with user charges. Industrial development supports, infrastructural supports that businesses need tend to work really well with user charges as well. So the moral of the story here is that while there are a lot of advantages to user charges, user charge revenue will never completely supplant tax revenue because we just cannot have as many situations in which we can utilize a user charge. So it will never replace tax revenue. It may erode the percentage of tax revenue that a government relies upon, but I don't think you're ever really going to see that tax revenue reliance go away. Another source of non-tax revenue are what we call monopoly-based revenue sources. So things like publicly owned and operated utilities. Many years ago, we had cities that referred to themselves as no-tax or low-tax cities. They called themselves no-tax or low-tax cities because they were generating so much revenue from operating a public utility that they didn't have to charge traditional tax rates. That's kind of gone away in the era of deregulation and breaking up a lot of these utilities. So you really don't have those no-tax or low-tax cities anymore, but public utilities still tend to generate a good source of monopoly-based revenue. Now, you are, as you know from accounting, very limited oftentimes in how you can use that revenue. You can borrow some of that revenue to put in your general fund, but usually that revenue needs to be paid back because monopoly-based revenue oftentimes goes into proprietary funds as opposed to your general governmental funds. So they generate a lot of revenue, and they also help us keep costs low and allow us to make sure that these utilities and these life-saving types of services are not being rationed to those who cannot afford them. Another monopoly-based revenue source are state-run lottery systems. And one interesting aspect of the Mikesell book is when he discusses lotteries, he provides for us a table that will show us the most efficient and the least efficient lottery systems. And he will compare amount of revenue generated from that state-run lottery to the administrative overhead costs. And when you look at that table, what you'll see is some state-run lottery systems actually cost more than they are generating in revenue. Now, California's state-run lottery system tends to be one of the more efficient ones, and so you have revenue that greatly exceeds your amount of overhead. But these state-run lottery systems were sold to voters based upon, well, we'll collect all this additional revenue, and we'll give this revenue to the schools. So this revenue will help out with education funding. As we know, very small amounts, very small percentage of education funding actually comes from lottery proceeds. But there is a state lottery program that provides lottery funds for K through 14 schools, as well as lottery funds to higher education. And so, a California state system, for example, receives lottery funds, and those lottery funds are meant to be used for instructionally related activities. So they can only be spent on types of expenditures that will benefit instruction in the classroom. So they are relatively restrictive in terms of how those monies can be spent. But a lottery is just another example of a monopoly-based revenue source. So to sum all this up, the moral of the story is that local governments are still reliant upon traditional tax-based sources of revenue, but they're much less so today than they were before the 1970s and before Proposition 13. So what Proposition 13 did is it forced a lot of local governments to diversify their revenue portfolio, which was painful at the time, but actually in the long run is not a bad strategy. As Mikesell tells us, one of the best ways for a local government to weather poor financial times is through revenue diversity. If they can diversify their revenue portfolio and spread out their reliance on different sources of revenue, then they're better able to weather poor fiscal times. So again, this is a brief overview, and you can have an entire class and other programs about revenue and tax-based sources of revenue. This is a very brief overview of the three main types of sources of tax-based revenue, as well as some non-tax revenue. What I really want you to take away from this is a general understanding of property, sales, and income taxes, and how they relate back then to those 5 evaluative criteria. Those 5 evaluative criteria will be very, very important for us as we move forward in the class. So I hope this information was helpful for you. As always, reach out if you have any questions, but I wish everyone a very good week.